there, it's Friday the 14th of June 2019. I'm Steve Towers. Welcome to ITB, coming to you today from Cebu in the Philippines. Let's get started. Well, as expected, the G20 finance ministers last weekend endorsed the Inclusive Frameworks Program of Work in regard to digitalisation. And the Program of Work was also the highlight of the OECD's Tax Talks webcast this week. And the most immediate action is to undertake the economic impact analysis of the various proposals. According to the OECD's David Bradbury, the target timeframe to provide the initial impact assessment is October or November. If you'd like to watch the OECD's recording of the Tax Talks webcast, please go to our website or app. The US Court of Appeals for the Ninth Circuit has delivered its decision in the Altera case, which concerns the validity of 2003 cost-sharing regulations in regard to employee stock compensation, a very important issue for quite a number of US multinationals, particularly in the tech sector. You'll remember that this case had to be reheard by the Ninth Circuit when one of the judges in the original three-judge panel, Judge Reinhardt, died before that panel's decision was delivered in 2018. That 2018 decision was subsequently withdrawn. The new three-judge panel consists of the two other judges from the original panel who gave opposing judgments in 2018. Chief Judge Thomas, who decided in favour of the government, and Judge O'Malley, who decided in favour of the taxpayer, plus a new third judge, Judge Graber. Well, in the 2019 decision, Chief Judge Thomas and Judge O'Malley didn't change their minds, and so it was up to Judge Graber to decide the winner. She joined with Chief Judge Thomas to form a majority in favour of the government. Here's a brief description of the facts. Altera, the taxpayer, is a US corporation and the parent of a group which designed, manufactured, marketed and sold programmable logic devices, which are electronic components that are used to build circuits. It entered into a cost-sharing agreement with a Cayman Islands subsidiary. Under that agreement, the parties agreed to share R&D costs in proportion to the benefits anticipated from new technologies developed from the R&D. Part of the R&D costs incurred by Altera was the cost of employee stock compensation. The issue in the case was whether Treasury was permitted for tax purposes to require that cost of employee stock compensation be included in the cost-sharing agreement. The majority's decision was delivered by Chief Judge Thomas, who set the scene in this way. This appeal presents the question of the validity of Regulation 482-7A-D2, under which related business entities must share the cost of employee stock compensation in order for their cost-sharing arrangements to be classified as qualified cost-sharing arrangements, QCSA. Although the case appears complex, the dispute between the Department of the Treasury and the taxpayer is relatively straightforward. the parties agree that under the governing tax statute, the arm's length standard applies, but they disagree about how that standard may be met. The taxpayer argues that Treasury must employ a specific method to meet the arm's length standard, a comparability analysis using comparable transactions between unrelated business entities. Treasury disagrees that the arm's length standard requires the specific comparability method in all cases. Instead, the standard generally requires that Treasury reach an arm's length result of tax parity between controlled and uncontrolled business entities. With respect to the transactions at issue here, the governing statute allows Treasury to apply a purely internal method of allocation, distributing the costs of employee stock options in proportion to the income enjoyed by each related taxpayer. Our task, of course, is not to assess the better tax policy nor the wisdom of either approach, but rather to examine whether Treasury's regulations are permitted under the statute. The statute is, of course, Section 482 of the Internal Revenue Code, which was amended in 1986 by the addition of this sentence. In the case of any transfer or license of intangible property, the income with respect to such transfer or license shall be commensurate with the income attributable to the intangible. According to Chief Judge Thomas, that sentence largely forms the basis of the present dispute. Chief Judge Thomas assessed the validity of the 2003 regulations against two independent standards: the Chevron standard and the State Farm standard. The Chevron standard is whether the conclusion reached in the regulations, the interpretation of a statutory provision, is reasonable. And the State Farm standard is whether there were flaws in the Treasury's decision-making process in regard to the regulations. I'll deal with each of those standards in turn. Chief Judge Thomas said that the Chevron standard involves a two-step analysis. Firstly, has Congress spoken directly on the precise question at issue? If not, then secondly, is Treasury's interpretation a permissible construction of the statute? In other words, one that is not arbitrary, capricious, or manifestly contrary to the statute. In regard to the first step, Chief Judge Thomas said this: here, the resolution of our Step 1 Chevron examination is straightforward. Section 482 does not speak directly to whether the Commissioner may require parties to a QCSA to share employee stock compensation costs in order to receive the tax benefits associated with entering into a QCSA. But the taxpayer argued that the additional sentence in Section 482 refers to any transfer or license of intangible property. That phrase would not cover a cost-sharing agreement under which the rights to intangible property are acquired by the Cayman Islands subsidiary ab initio. However, that argument was rejected by Chief Judge Thomas, who said this: we are not persuaded. When parties enter into a QCSA, they are transferring future distribution rights to intangibles, albeit intangibles that have yet to be developed. Indeed, the present-day transfer of those rights provides the main incentive for entering into a QCSA. The right to distribute intangibles to be developed later is itself one right in the bundle of property rights that exists at the time that parties enter into a QCSA. Moreover, even assuming that the crucial transfer does not occur contemporaneously, Section 482 applies in the case of any transfer of intangible property that produces income. That phrasing is as broad as possible, and it cannot be read to exclude the transfers of expected intangible property. In short, the text of the statute does not limit its application to pre-existing intangibles in the way Altera's argument suggests. And so Chief Judge Thomas proceeded to the second step of the Chevron standard, which inquires whether Treasury's interpretation is a permissible construction of the statute. In other words, one that is not arbitrary, capricious, or manifestly contrary to the statute. He concluded that the regulation is a permissible construction of Section 482. Let me set out his reasoning in some length. In the 1986 amendments, Congress called for an approach to allocation of costs and income that would reasonably reflect the actual economic activity undertaken by each party to a QCSA. Put another way, Congress's objective in amending Section 482 was to ensure that income follows economic activity. Although the 1986 amendment delegates to Treasury the choice of a specific methodology to achieve that end, it suggested, in the case of any transfer or license of intangible property, the income with respect to such transfer or license shall be commensurate with the income attributable to the intangible. This standard is a purely internal one, that is, internal to the entity being taxed, and evidence supports Treasury's belief that Congress intended it to be. In light of this history, Treasury's decision to adopt a methodology that followed actual economic activity was reasonable. So was Treasury's determination that uncontrolled cost-sharing arrangements do not provide helpful guidance regarding allocations of employee stock compensation. When it amended Section 482 in 1986, Congress bemoaned the difficulties associated with finding and using comparable data involving high-profit intangibles. It follows that Congress granted Treasury authority to develop methods that did not rely on analysis of these problematic comparable transactions. What is more, although Altera suggests there can be only one understanding of the methodology required by the arm's length standard, historically, the definition of the arm's length standard has been a more fluid one. Indeed, for most of the 20th century, the arm's length standard explicitly permitted the use of flexible methodology in order to achieve an arm's length result. It is true that more recently, an understanding that the primary means of reaching an arm's length result suggested the analysis of comparable transactions. But in the lead up to the 1986 amendments, Congress voiced numerous concerns regarding reliance on this methodology. Further, courts for more than half a century have held that a comparable transaction analysis was not the exclusive methodology to be employed under the statute. In light of the historic versatility of methodology, it is reasonable that Treasury would understand that Congress intended for it to depart from analysis of comparable transactions as the exclusive means of achieving an arm's length result. In sum, Treasury reasonably understood Section 482 as an authorization to require internal allocation methods in the QCSA context, provided that the costs and income allocated are proportionate to the economic activity of the related parties. These internal allocation methods are reasonable methods for reaching the arm's length results required by statute. While interpreting the statute to do away with reliance on comparables may not have been the only possible interpretation of Congress's intent, it proves a reasonable one. Thus, Treasury's interpretation is not arbitrary, capricious, or manifestly contrary to the statute, and it is therefore permissible under Chevron. The taxpayer also argued that comparability is required in order to meet the US's obligations under Article 9 of double tax treaties. Chief Judge Thomas said this: Alterra makes much of the United States' treaty obligations with other countries, asserting that a purely internal standard is inconsistent with the standards agreed to therein, and is therefore unreasonable. However, there is no evidence that our treaty obligations bind us to the analysis of comparable transactions. As demonstrated by nearly a century of interpreting Section 482 and its precursor, the arm's length standard is not necessarily confined to one methodology. It reflects neither how related parties behave nor how they are taxed. Just pausing there for a moment, that view is consistent with the rest of the Chief Judge's decision. However, it does mean that US legislation and legislative history influences the interpretation of the arm's length principle in double tax treaties. US treaty partners might beg to differ. And speaking of unilateral viewpoints, he then says this: moreover, our most recent treaties incorporate not only the arm's length standard, but also the 2003 regulations. See, for example, the US Treasury's technical explanation of the 2013 US-Poland Treaty. It is understood that the Code Section 482, commensurate with income standard for determining appropriate transfer prices for intangibles, operates consistently with the arm's length standard. The implementation of this standard in the regulations under Code Section 482 is in accordance with the general principles of Paragraph 1 of Article 9 of the Convention. The problem, of course, is that the US Treasury's technical explanation is a unilateral document. There's no evidence that Poland shares this view of Article 9.1. Under the State Farm Standard, the question is whether there were flaws in the decision-making process in regard to the regulations. Chief Judge Thomas addressed a number of issues in regard to this question. However, the most significant issue was the taxpayer's claim that Treasury did not respond in detail to public comments that taking stock-based compensation into account in the QCSA context would be inconsistent with the arm's length standard. Chief Judge Thomas described these public comments in this way. Commenters attacked the proposed regulations as inconsistent with the traditional arm's length standard because the methodology did not involve an analysis of comparable transactions. To support their position, they primarily discussed arm's length agreements in which unrelated parties did not mention employee stock options. They explained that unrelated parties do not share stock compensation costs because it is difficult to value stock-based compensation, and there can be a great deal of expense and risk involved. But Chief Judge Thomas rejected the taxpayer's claim. By submitting the cited transactions between unrelated parties, the commentators apparently assumed that Treasury would employ analysis of comparable transactions. This assumption, however, overlooks Treasury's decision to do away with analysis of comparable transactions in the first place, a decision that was made clear enough by citations to legislative history in the Notice of Proposed Rulemaking and in the preamble to the final rule. As discussed in our Chevron analysis, Treasury's conclusion that it could require parties to a QCSA to share all costs was a reasonable one. Thus, significant comments that required a response would have spoken to why this interpretation was not, in fact, reasonable, so that adopting the comments would require Treasury to change the regulation. As an example, Treasury would have been required to respond to comments demonstrating that doing away with analysis of comparables did not, in fact, serve the purposes of parity set out in the statute. Indeed, the cited transactions actually reinforced the original justification for adopting a purely internal methodology, the lack of transactions comparable to those occurring between parties to a QCSA. Specifically, as Treasury remarked, the submitted transactions did not share enough characteristics of QCSAs involving the development of high-profit intangibles to provide grounds for accurate comparison. Because of this lack of similar transactions, Treasury justifiably chose to employ methodology that did not depend on non-existent comparables to satisfy the commensurate with income test and achieve tax parity. In this way, the comments reinforced Treasury's premise for adopting the purely internal methodology. Treasury did not err by refusing to examine them more rigorously. For a copy of this case, please go to our website or app. The Court of North Holland has decided an interesting case concerning the impact, under the Dutch domestic tax law and the Netherlands-Russia double tax treaty, of Russia's thin capitalisation rules. Here are the facts. A Netherlands company made 2 loans to a related Russian company. The loans carried fixed-rate interest. The Russian company breached Russia's thin cap rules, which use a 3-to-1 debt-to-equity ratio. Consequently, part of the interest on the 2 loans was non-deductible and was deemed to be a dividend for Russian tax purposes. It was therefore subject to Russian dividend withholding tax, which was levied at 15% under the Netherlands-Russia Treaty. An important aspect of the case is that Russia's thin cap rules applied only by use of a fixed debt-to-equity ratio, which was 3-to-1. There was no alternative arm's length test under those rules. Another important aspect of the case concerns timing. The Netherlands-Russia Treaty was signed in 1996 and commenced operation on the 1st of January 1999, whereas the Russian thin cap rules were introduced in 2002. The Netherlands company made 2 alternative claims. The first was that for Dutch tax purposes, the disallowed interest should be treated as a dividend and should therefore be subject to the participation exemption under Dutch domestic tax law. The second alternative claim is that under the Netherlands-Russia Treaty, it is entitled to a foreign tax credit for the Russian dividend withholding tax. I'll now look at these 2 claims in turn. The Netherlands company's first claim was that for Dutch tax purposes, the disallowed interest should be treated as a dividend and should therefore be subject to the participation exemption under Dutch domestic tax law. The court considered this claim from two perspectives. Firstly, whether the loans should be characterised as equity for Dutch tax purposes, regardless of the Russian thin cap rules. And secondly, whether Article 9 of the treaty requires the excess amount of the loans to be recharacterised as equity. In regard to the first perspective, the court concluded that there was nothing in the terms of the loans which would warrant them being characterised as equity rather than debt. The second perspective concerns Article 9 of the Netherlands-Russia Treaty, which relevantly is in the same form as Article 9 of the OECD Model Treaty. The court considered whether Russia's thin cap rules, and in particular the fixed 3-to-1 ratio, were consistent with the arm's length principle in Article 9.1. It held that they were not, or more correctly, it held that the Netherlands company, which bore the burden of proof, had not established that they were consistent with the arm's length principle. The court said this: the Russian thin capitalisation rules are based on certain capital ratios. In the opinion of the court, it is not possible to conclude, purely on the basis of those capital ratios, that there is an improper profit shift within the meaning of Article 9 of the treaty. The Russian thin capitalisation rules are not in accordance with and do not elaborate on the arm's length principle of Article 9 of the treaty. The taxpayer, on whom, in the opinion of the court, the burden of proof rests, has not provided any facts and/or circumstances to support the position that the thin cap rules are consistent with Article 9. More specifically, the capital ratios used by Russia do not have any objective basis, but are merely based on a one-sided assessment. Now, you might ask, what would have happened if the court did conclude that the Russian thin cap rules were consistent with the arm's length principle? Well, that would mean that disallowance of the interest deduction would be accepted as an application of the arm's length principle. But it would still take the Netherlands company some effort to have the loans recharacterised as equity for Dutch tax purposes. On this issue, the court said, under the Dutch transfer pricing rules, it is stated that, based on the OECD guidelines on transfer pricing, the arm's length test with regard to financing transactions proceeds as follows. It is first assessed whether the conditions, including the price, under which the transaction was concluded, correspond to the conditions that would have been agreed by independent third parties in a comparable transaction under comparable circumstances. If the conditions do not match, the consequences must be corrected. 1.6 OECD Transfer Pricing Guidelines. This correction must in the first instance be made with a price adjustment, interest. In case the money loan with a price adjustment cannot be made at arm's length, it must be considered whether the loan can be made at arm's length with the adjustment of other conditions. If an at arm's length situation cannot be achieved with this, then in the most extreme case, the loan can be ignored or requalified. 1.65 OECD Guidelines on Transfer Pricing. So, as you can see, there's a hierarchy of responses if the arm's length principle is not satisfied. First, change the price. Secondly, change the other conditions. And thirdly, either ignore or requalify, in other words, recharacterise the loan. And although the court didn't actually say this, the inference seems to be that if the appropriate Article 9 adjustment is to recharacterise the loans as equity, that recharacterised treatment would apply not only for the purposes of the treaty, but also for the purposes of Dutch domestic tax law, which would mean that the participation exemption would be available. However, the Netherlands company didn't achieve that outcome because it failed to establish that the Russian thin cap rules are consistent with Article 9. The alternative second claim by the Netherlands company is that the Netherlands-Russia Treaty entitles it to a foreign tax credit for the Russian dividend withholding tax. The court also considered this claim from two perspectives. Firstly, the definition of dividends in Article 10.4 of the treaty. And secondly, the comments on conflicts of qualification in the OECD commentary on Articles 23A and 23B. The definition of dividends in Article 10.4 of the Netherlands-Russia Treaty is this. The term dividends, as used in this article, means income from shares or other rights not being debt claims participating in profits, as well as income from other corporate rights which is subjected to the same taxation treatment as income from shares by the laws of the state of which the company making the distribution is a resident. Although this definition is less complex than the corresponding definition in the OECD Model Treaty, you can see that it can be broken down into the familiar three parts: income from shares, income from other rights not being debt claims participating in profits, and income from other corporate rights which is subjected to the same taxation treatment as income from shares by the laws of the state of which the company making the distribution is a resident. The court easily dealt with the second and third parts of this definition. In regard to the second part, income from other rights not being debt claims participating in profits, the court said, well, the loans are debt claims and they carry fixed rates of interest and therefore they don't participate in profits. And so it concluded that the second part of the definition was not satisfied. In regard to the third part, income from other corporate rights, the court said that loans are not corporate rights, but instead are rights under a loan agreement. In other words, to fall within the third part, the rights must relate to the corporate structure of the company, as opposed to being mere agreements. The two loans don't satisfy this test. But what about part one of the definition, income from shares? Under the Russian thin cap rules, the disallowed interest is deemed to be a dividend, which is then subject to dividend withholding tax. If it's deemed to be a dividend in Russia, why would it not be income from shares? Well, the court responded to that question in two ways. Firstly, the court said this. In the opinion of the court, a requalification of interest as a dividend on the basis of thin capitalization rules in Russia cannot be based on Article 10 of the treaty. If it were otherwise, this should be explicitly included in the treaty text. In 2008, Russia entered a reservation on Article 10 of the OECD Model Tax Convention to introduce a provision in a tax convention so that Russia could apply its national thin capitalization legislation, notwithstanding any other provision in the convention. This has happened, for example, in the protocol amendments to the tax treaties that Russia has concluded with Cyprus, Switzerland, and Luxembourg. The treaty definitions for dividend and interest have been adjusted accordingly. This has not happened with the Netherlands in the treaty. And for the court's second response, it said this. The treaty was concluded with Russia on the 16th of December 1996, and became applicable from the 1st of January 1999. The 2002 thin capitalization legislation wrongly extends Russia's taxation rights in violation of the treaty, leading to treaty override. Treaty override is contrary to the good faith that applies between contracting states on the basis of Article 26 of the Vienna Convention. In the present case, the requalification of the interest as a dividend on the basis of Russian thin capitalization legislation has partially shifted the exclusive taxation right from the Netherlands on the basis of the current treaty with regard to interest to Russia with the right to levy dividend withholding tax. This was not agreed between Russia and the Netherlands at the conclusion of the treaty, and in the opinion of the court, in the absence of a concrete substantiation with facts and or circumstances, it was not the intention of Russia and the Netherlands to subsequently agree to come to a treaty change. Let me now turn to the second perspective considered by the court, the comments on conflicts of qualification in the OECD commentary on Articles 23A and 23B. Not surprisingly, the court referred to the observation made by the Netherlands government in the OECD commentary on those two articles. The Netherlands does not agree with the interpretation given in paragraphs 32.4 and 32.6 to the phrase "in accordance with the provisions of this convention" in Articles 23A and 23B of the convention, that in cases of conflicts of qualification that are due to differences in domestic law between the state of source and the state of residence, as a rule, the qualification given by the state of source would prevail for purposes of the application by the state of residence of Article 23A or 23B. The Netherlands, therefore, will adhere to said interpretation in paragraphs 32.4 and 32.6 only and to the extent which it is explicitly so confirmed in a specific tax treaty, as a result of mutual agreement between competent authorities or as unilateral policy, none of which has occurred. And so the court effectively concluded that the OECD commentary on Articles 23A and 23B provided no support for the Netherlands company's claim for a foreign tax credit. And so the Netherlands company didn't secure any double tax relief in the Netherlands, exemption or credit for the Russian dividend withholding tax. This means that the amount of disallowed interest effectively suffers three levels of taxation. Firstly, Russian corporate income tax on the taxable profits of the Russian company, which are higher by the amount of the disallowed interest. Secondly, Russian 15% dividend withholding tax. And thirdly, Netherlands corporate income tax. Strangely, the court made no comment on the obvious technical solution to the first of these tax costs. Russia should be prevented by the non-discrimination article in the treaty from applying its thin cap rules to deny part of the interest deduction for the Russian company. Article 25.3 says this: except where the provisions of paragraph 1 of Article 9 apply, interest, royalties or other disbursements paid by an enterprise of a contracting state to a resident of the other contracting state shall, for the purpose of determining the taxable profits of such enterprise, be deductible under the same conditions as if they had been paid to a resident of the first mentioned state. Russia's thin cap rules apply only to outbound payments. Thus, the benchmark in Article 25.3, as if they had been paid to a resident of the first mentioned state, would allow the interest expense to be deductible, regardless of the thin cap rule, subject to the exception of Article 9.1. In other words, the thin cap rules would be applicable only if and to the extent that they are consistent with the arm's length principle in Article 9.1. Now, of course, there's no guarantee that the Russian tax authorities would agree that a fixed 3-to-1 debt equity limit is not consistent with the arm's length principle. But that's where the mutual agreement procedure would become relevant. For a copy of this case, please go to our website or app. The UK's upper tribunal has decided an interesting case concerning the central management and control test for corporate tax residents, which is used in the UK and many Commonwealth jurisdictions. This is an appeal from the 2017 decision of the First Tier Tribunal. You might remember that I covered that 2017 decision in my previous video podcast series. The case concerns whether 3 Jersey incorporated companies were resident in the UK under the Central Management and Control Test. The 3 Jersey companies were incorporated by a UK group in order to participate in a UK tax planning scheme concerning capital losses. For the success of the scheme, it was critical that the 3 Jersey companies were not UK resident at the start of the scheme, but became UK resident at a later stage. Let me explain. UK companies in the group owned a number of assets on which there were unrealised capital losses. The scheme was designed to increase the quantum of the capital losses by applying an inflation indexation allowance to the base cost of the assets. Under the UK law, an inflation indexation allowance is applied to reduce the amount of a capital gain, but it does not apply to increase the amount of a capital loss. The scheme was designed to achieve just that. The UK companies granted call options over the relevant assets to the 3 Jersey companies. Each exercise price was equal to the base cost plus the indexation allowance. That amount was significantly higher than the current market value of the relevant asset. The Jersey companies then exercised the options and paid the exercise price, with the funding provided by share capital subscribed by the UK parent company. And this caused the UK companies to generate no gain and no loss. However, when the Jersey companies later sold the assets, their base cost would be equal to that exercise price. And accordingly, the capital loss they would incur would effectively include the indexation allowance. For this scheme to succeed, it was critical that the Jersey companies were non-resident at the time of their acquisition of the assets, but were resident at the later time when they sold the assets. During the period when the 3 Jersey companies were intended to be non-resident, they each had 3 Jersey resident directors who were provided by a corporate services company, and a UK resident director who was the company secretary of the UK parent company. During this period, all board meetings of the 3 Jersey companies were physically held in Jersey. At these board meetings, the option grant and exercise and funding transactions were approved, as well as a number of corporate and administrative formalities. Some days later, the Jersey directors resigned and UK directors were appointed, with a view to the Jersey companies becoming UK resident from that time. Shortly after, once it was considered that the Jersey companies were UK resident, steps were taken for the Jersey companies to sell the relevant assets, thereby triggering capital losses, each of which, as I said, reflected the relevant indexation allowance. In its 2017 decision, the first-tier tribunal decided that the central management and control of the Jersey companies at all times was exercised by the UK parent company in the UK. The three Jersey companies were therefore tax resident in the UK at all times. The primary reason for that 2017 decision was that the Jersey directors, who should have exercised central management and control, did not do so because they had abdicated their responsibility for management and control. And the evidence of such abdication of responsibility was the fact that the exercise prices under the call options were significantly higher than the current market values of the assets, which meant that the three Jersey companies knowingly paid too much for the assets. The first-tier tribunal said this: "In our view, there is a difference between, for example, engaging a board of directors to operate a company with a limited or group function, such as a finance function for the group, which responds to proposals put by the parent in the expectation they will be approved because they make commercial sense, and engaging a board to perform a single act, which is wholly uncommercial from the company's own perspective, on the basis control is then almost immediately handed back to the parent. It is inherent in the uncommercial nature of what was proposed, or in other words, that lack of any commercial benefit evidences that the board were undertaking to implement the necessary steps from the outset on the say-so of the parent, subject to the legality issue. We cannot see on what other basis the directors of a company would sign up to take on such a project." And later it said, "This was not a case where the board considered a proposal and, having taken appropriate advice, decided it was in the best interests of the companies to enter into it. Given that the transaction was clearly not in the interests of the companies, and indeed could only take place with parental approval, the inescapable conclusion is that the board was simply doing what the UK parent wanted it to do, and in effect instructed it to do. In the circumstances, the line was crossed from the parent influencing and giving strategic or policy direction to the parent giving an instruction. The Jersey board were simply administering a decision they were instructed to undertake by the UK parent, in checking the legality of the plan and then administering the other consequent actions prior to handing over completely to the UK group. Well, would you believe it? On appeal, the upper tribunal has reversed the 2017 decision. It did so for two reasons. Firstly, it considered that the Jersey companies did not enter into an uncommercial transaction. It said this: "It is wrong to say that the relevant assets were acquired by the Jersey companies on uncommercial terms, in the sense that they, the Jersey companies, were economically disadvantaged. As we have pointed out, it was envisaged that the acquisition of the relevant assets would be funded by the UK parent company, and that is what in fact occurred. Thus, whilst the relevant assets were acquired at an overvalue, the overpayment by the Jersey companies was not funded by them. We therefore have grave doubts regarding the FTT's description of the Jersey company's participation in the scheme and their acquisition of the relevant assets as being uncommercial when considering only the position of the Jersey companies. The second reason given by the upper tribunal would apply even if the first-tier tribunal was right in holding that the Jersey companies acquired the assets on uncommercial terms. This second reason relates to the duties of the directors of the Jersey companies under Jersey company law. The upper tribunal said this: the Jersey company law requires consideration of the interests of members or shareholders, employees, and creditors. In this case, given that the Jersey companies had no employees and the transactions that the Jersey companies were to enter into pursuant to the scheme did not prejudice creditors, the primary consideration can only have been the interest of the shareholders. The Jersey companies were 100% subsidiaries of the UK parent company. The primary regard of the Jersey directors ought to have been, and as it seems to us, was, directed to what was in the best interests of the UK parent company qua shareholder. It is clear that the Jersey directors had well in mind the duties they were subject to and were seeking to act in accordance with those duties. They gave detailed consideration to the appropriateness of the scheme, including the apparently uncommercial nature of the options and the acquisition by the Jersey companies of the relevant assets, and concluded that the transactions were in the best interests of the shareholders and therefore in the best interests of the Jersey companies. The FTT erroneously took the view that because the transactions were uncommercial, they had to be contrary to the interests of the Jersey companies. That, with great respect to the FTT, is a non sequitur and it undermines the entire FTT decision. And so the upper tribunal concluded that during the relevant time, the central management and control of the Jersey companies was exercised by the Jersey directors in Jersey. And thus, during that time, the Jersey companies were not tax resident in the UK. For a copy of this case, please go to our website or app. In Australia, a government agency, the Fair Work Ombudsman, has completed an investigation into the relationship between Uber Australia and its drivers. The conclusion is that the relationship is not an employment relationship. For an employment relationship to exist, the courts have determined that there must be, at a minimum, an obligation for an employee to perform work when it is demanded by the employer. Our investigation found that Uber Australia drivers are not subject to any formal or operational obligation to perform work. This decision appears to be at odds with a 2016 UK Employment Tribunal decision also in regard to the Uber Group. As you know, employment status can be critical in regard to a number of tax obligations, such as whether a non-resident entity has a PE in the source country, payroll withholding tax obligations, and VAT or GST obligations. For a copy of the Ombudsman's press release, please go to our website or app. In India, the Pune Income Tax Appellate Tribunal has decided an interesting transfer pricing case. In its TP study, an Indian company applied the transactional net margin method, with operating profit as a percentage of sales as the profit level indicator. Well, not operating profit. Instead, it used operating profit before depreciation. It argued that it was appropriate for it to do so because it charged depreciation in its accounts at rates higher than was required under the Indian Companies Act. and therefore its depreciation expense was substantially higher than the depreciation expense in its set of comparables. The tribunal held that under the Indian TP rules, operating profit before depreciation cannot be used. It must be operating profit. However, an adjustment should be made if the taxpayer has used depreciation rates higher than those used by the comparables for like assets. But that's all. No further adjustment should be made for the situation where the taxpayer's total depreciation expense is higher than that of the comparables. For a copy of this case, please go to our website or app. In Mongolia, tax reform legislation has been enacted to be effective the 1st of January 2020. A number of items caught my eye. A general anti-avoidance rule will be introduced. The transfer pricing rules will be amended to align with the OECD guidelines. There will be a small amendment in the corporate income tax rate. The lower rate of 10% will now apply to taxable income up to 6 billion Mongolian tugrik, which is about $2 million US, instead of the current 3 billion tugrik. After that threshold, the current 25% rate will apply. An earnings stripping rule based on BEPS Action 4 will be introduced, with the ratio set at 30% of EBITDA. The existing thin cap limit of 3-to-1 debt to equity ratio will also apply. And recovery of input VAT on capital expenditure will now be possible, although depending on the circumstances, there might be a significant delay. In the Czech Republic, the government has issued new guidance on transfer pricing. The new guidance is aligned with the 2017 OECD transfer pricing guidelines. For a copy of the new guidance, please go to our website or app. The European Commission has published its 2019 country-specific recommendations, which provide policy guidance for EU member states, including in regard to aggressive tax planning. 6 member states have received recommendations to do more in regard to measures to curb aggressive tax planning: Cyprus, Hungary, Ireland, Luxembourg, Malta, and the Netherlands. Although I would say that in some of these cases, the recommendation is for the member state to carry on doing what it's already doing. For example, the recommendation to the Netherlands includes this statement: address features of the tax system that may facilitate aggressive tax planning, in particular by means of outbound payments, notably by implementing the announced measures. For a copy of the country-specific recommendations for all 28 EU member states, please go to our website or app. And the Commission has announced that it has referred 2 member states to the European Court of Justice in regard to tax matters: Austria for its failure to align with EU VAT rules for travel agents, and Spain for imposing disproportionate sanctions for failures to report assets held abroad. For a copy of the Commission's 2 press releases, please go to our website or app. In Germany, the Federal Tax Court has decided a case in regard to the German tax treatment of income from a carried interest in business-type fund structures. The court held that the income from a carried interest in such structures would take the same tax treatment as the underlying income in the fund. So, if the underlying income consists of dividends and capital gains, the carried interest income would benefit from the tax exemption or partial tax exemption for dividends and capital gains. For a copy of this case, please go to our website or app. In Gibraltar, the government has presented its 2019 budget. There's only one item I noted. The government is proposing the introduction of a notional interest deduction in order to better align the tax treatment of equity and debt. In Malta, the government has published in the official Gazette the rules for the new tax consolidation regime to be effective in the 2020 year of assessment. The regime will operate by way of a fiscal unit, which can be formed by election by a parent company and its 95% direct and indirect subsidiaries. If a fiscal unit is formed, the direct and indirect subsidiaries in the fiscal unit are deemed to be transparent for Maltese income tax purposes. Thus, all income and expenses are deemed to be derived and incurred by the parent company. However, although the parent company will be assessed, all members of the fiscal unit will be jointly and severally liable for the payment of income tax by the parent. For a copy of the rules for this new regime, please go to our website or app. In Poland, the government has delayed the replacement of VAT returns with the standard audit file for tax. The replacement date has been moved from the 1st of July 2019 to January 2020 for large taxpayers with over 250 employees or annual turnover exceeding the equivalent of 50 million euros, and July 2020 for all other taxpayers. In Mauritius, the government has presented its 2019 budget. It contains a number of interesting items. First and foremost, there are proposed changes to the partial exemption regime. Firstly, the scope of the regime will be extended to companies engaged in leasing and provision of international fibre capacity, reinsurance and brokering of reinsurance services, or sale, financing arrangement or asset management of aircraft and spare parts, including aviation-related advisory services. And secondly, there will be introduced detailed substance requirements for a company to enjoy the partial exemption regime. The budget also proposes the introduction of new tax holidays for innovation-driven activities, setting up an e-commerce platform, peer-to-peer lending, oil bunkering, and development of a marina. And two other interesting changes. CFC rules will be introduced, and the test for non-residents for a company incorporated in Mauritius will be changed from place of effective management being outside Mauritius to central management and control being outside Mauritius. In Argentina, legislation to promote a knowledge economy has been enacted to be effective for a 10-year period from the 1st of January 2020. Qualifying entities will enjoy a number of benefits, most notably fiscal stability, a guarantee that their total national tax burden will not be increased during the 10-year period, a 15% income tax rate, and reduction in social security contributions. For a copy of the legislation, please go to our website or app. In Costa Rica, the government has issued a decree which contains regulations for the implementation of VAT, which will replace sales tax on the 1st of July. For a copy of the decree, please go to our website or app. In Peru, the government has issued guidance in regard to the imposition of tax on indirect share transfers, transfers of shares in non-resident companies which own shares in resident companies. The guidance focuses on the determination of the market value of the two sets of shares, the shares in the non-resident holding company and the shares in the underlying resident company. For a copy of the guidance, please go to our website or app. In the US, the Court of Appeals for the DC Circuit has decided the appeal in the Grecian Magnesite case. The court has confirmed the 2017 decision of the US Tax Court. That 2017 US Tax Court decision had rejected the IRS position that a foreign partner's capital gain from the sale of an interest in a partnership which is engaged in a US trade or business is treated as effectively connected with a US trade or business and therefore is subject to US income tax. For a copy of the Court of Appeals decision, please go to our website or app. And would you believe it? There are indications that the US Senate's Foreign Relations Committee will finally meet next week to clear the backlog of tax treaties and protocols which require ratification. We shall see. And now for this week's treaty developments. We've had 2 treaties signed, 2 protocols signed, 1 treaty enter into force, and 2 protocols enter into force. Well, that's the way it is this Friday, the 14th of June, 2019. I'm Steve Towers in Cebu. Have a great weekend.